Hallo und herzlich willkommen zu unserem heutigen Scope-Webinar. Das Thema heute ist Multi-Asset 3.0 und 3.0 deswegen, weil sich Multi-Asset-Fonds gewandelt haben. Das heißt, viele schauen über den Tellerrand von Aktien, Renten, Cash-Investments hinaus und integrieren neue Anlageklassen wie Listed Alternatives oder integrieren Nachhaltigkeit. Und das ist auch genau das Thema, um das es heute geht. Inwieweit macht das Sinn? Wie lässt sich das umsetzen? Und was sind die Vorteile von Multi-Asset 3.0? Dafür haben wir heute den Fondsmanager Simon Holmes vom BMO Asset Management hier, der auch einen Fonds bei ein Multi-Asset Sustainable Growth Fund bei BMO managt. Und bevor wir loslegen, wollte ich kurz noch ein paar Worte zu BMO Asset Management sagen für diejenigen unter Ihnen, die BMO noch nicht kennen. BMO steht für Bank of Montreal und das ist der Asset Management Arm der BMO-Gruppe, die 1817 gegründet wurde. Die Gruppe verwaltet etwas mehr als 700 Milliarden kanadische Dollar und hat mehr als 45.000 Mitarbeiter und bietet ihren Kunden eine breite Palette von Produkten und Dienstleistungen im Bereich Privat-, Firmenkundengeschäft, Vermögensverwaltung und Investmentbanking an. Der Fokus von BMO Global Asset Management liegt auf nachhaltigen Strategien, die bereits seit 1984 umgesetzt werden. BMO Global Asset Management war auch bereits zweimal im letzten und vorletzten Jahr bei den Scope Fund Awards als bester Asset Manager im Bereich ESG nominiert. Bevor wir mit der Q&A-Session mit Simon beginnen, beachten Sie bitte, dass Sie die Möglichkeit haben, während des Webinars Fragen zu stellen. Wenn Sie eine Frage an den Fondsmanager haben, dann tippen Sie diese bitte in Englisch oder Deutsch in das Chat-Window auf der rechten Seite ein und ich würde dann im Laufe des Webinars darauf zurückkommen. So, but now let's switch over to English and move on to our Q&A session with the fund manager Simon Holmes. So, Simon, happy to have you today. Welcome to our webinar.
Hi, Barbara, and hello, everybody. Thanks for having me on the webinar. Thanks also for switching to English. My German isn't quite so good. So my name is Simon Holmes. I've been at BMO since 2007, and I'm a member of the multi-asset team. I work on all of our products, and I lead on the sustainable multi-asset range of products that we have. And this includes the sustainable multi-asset income fund that we're talking about today. I'm very fortunate at BMO to have a large responsible investment team there, which has got a depth of experience and also a large number of team members. And we at BMO have been doing sustainable or responsible investment since 1984. So we've got a lot of experience to draw on. And I think when we think about how I work with them, I communicate with those responsible investment team members a lot. And I also work closely with members across our other investment teams. And the two things I'm really trying to do, I'm trying to make sure that when we apply sustainability, we do that consistently across all the different asset classes. But I'm also still very aware of the financial market and the economy. And we need to make sure that our asset allocation is drawing on that in the right way. So that's important. And sustainability evolves over time quite quickly, so it's up to us to make sure we're staying ahead of things as they evolve.
Thank you very much for your introduction, Simon. My first question to you is that you are following an active approach to asset allocation. So could you please give us an overview how your process works and what drives your allocation in the fund?
I can, and I'm going to see if I can make a slide up here. Ooh, can everybody, hopefully we can see a slide here.
Yes.
So if I just click on, this is a sort of generic slide, but I think it gives a good sense of what we're doing. When we think about asset allocation, we're thinking about two levels. We're thinking about strategic asset allocation, which is longer term, quite driven by fundamentals, so earnings for equities, the economy, and so on, and also what's the prospects for growth and inflation, and that helps us to think about bonds and bond yields. And that part of the allocation process moves fairly slowly. We look at it and adjust it quarterly, and we're really trying to work out longer term, are the opportunities there to be in risky assets or not? actually the other part of asset allocation, which is at the other end of this slide, tactical asset allocation, is still thinking about how much risk you want in equities or corporate debt or alternatives or government bonds. But here we're thinking on a shorter term time frame. We're thinking about what's going on in the economy in terms of events coming up, whether that's elections or whether that's central bank meetings. And obviously in the time of COVID, there's other things around reopening, such as we're just experiencing in the UK. We'll still think of valuations as well, but we'll also take into account behavioral issues such as market positioning and flows and so on. And between those two parts, the strategic longer term and the tactical shorter term, and we look at that second part, I should have said, monthly and even every day, that gives us the right way to allocate our assets, if you like, overall. But within that, and the middle column here, security selection, we have allocated risk down to experts in each area, and they help us to pick the right stocks, which then help to build up to that asset class level allocation. I mean, it's a relatively cautious fund. So for us, the equity weight won't go above 50%, and the alternatives weight won't go above another, say, 15 to 20%. But at times we've been much lower than that, and we'll see that later on. Just going to unpin the slide, I hope. Has that worked?
We still see the slide, Simon, but I would like to come to my next question. So thanks for running us through the asset allocation aspects. The next aspect I want to ask you about is really the core question. So because your approach differs from traditional multi-asset processes, as I already mentioned in my intro, by including sustainable investments or a sustainable strategy and alternative investments. So why it is so important in your view to include these two other aspects into your multi-asset fund?
Okay, I would like to maximize my screen now if I can, but we'll see. Yeah, so the two parts of that really, which you picked up, sustainability, and I think that's really the core part of this fund actually. We thought it's really important, just as it is in many other parts of life, that people who want to invest can invest in a way that is aligned with their values. And increasingly these days, for many people, we're all becoming very aware of climate change, the need to do something about that. And obviously recent events that we've seen in London and particularly in Germany have really underlined that, just how quickly things can change. So I think it's becoming a very well understood issue, climate change specifically, but there are other parts as well of sustainable investment, thinking about how can we make the world the right place for all sorts of things to happen, people to live, economy to work well, and so on. So the first part of this, the sustainability part, is saying, let's make investment products where people can still expect good returns with the right amount of risk, but where also they can be 100% aligned with their values and not owning companies such as fossil fuels, for example, and actually allocating to positive solutions, if you like, and we'll come on to some more of that later. But that's the sustainability bit, and I'm very, very proud that we've made these products which seem to be working well from that perspective, whilst also delivering good returns. The other part of your question, which is the alternatives, I think it's important to build a diversified portfolio, and what you can get in the sort of non-standard equity and fixed income part is you can get access to real assets. That can be things such as property, infrastructure, and other things like that. And within a sustainable context, it is still possible to do that to a reasonable degree. It is more limited, perhaps, than in a non-sustainable. But if you think about how our fund operates, it's completely sensible for us to allocate capital to renewable infrastructure, so wind farms and solar panels and things that go around accessing that, for example. Also, property, whether that's related to healthcare or social housing, that's also something which is an alternative that does align well with this type of fund. So that's how we incorporate it. With the alternatives, you do get some diversification. You get an income stream as well, which you won't necessarily get so much from standard equities. And we think really this is what makes this a good all-round multi-asset product.
Thank you, Simon. And before we move on to more ESG questions, I have another question about strategy, because a key part of the strategy is a tactical downside protection. So this is something which is really a challenge for most fund managers to get that right. So could you please tell us how it works and how effectively it has proven over prior market drawdowns so far, and maybe whether you have a specific risk target of the fund?
Yes, okay. So, I mean, when we saw the earlier slide on strategic and tactical asset allocation, I think about within tactical asset allocation, that is where we will spend some time thinking about managing risk. And as you can see on the slide, it talks about short-term opportunities and risks. And what we're doing really, we know that we're not going to get everything right. We know that it's impossible to just know what's going to happen. But what we can do is we can look ahead and we can see where are there specific events that come up. So that might be, for example, an election. And you know that even if you don't know the outcome, you know it's something that it will be a focus point for the markets. So that's one thing we can do, is to just look ahead. A related thing we can do is to track things as they're evolving. And when something comes up out of the blue, we can then sit and look at scenarios for how bad that can get. So in an example last year, or yeah, it would be last year, when COVID started and we all started to hear about that in China, I think many people initially thought, well, it will be like, you know, other flu outbreaks that we've seen from that region. It's unlikely to spread. And we also had that view. But once we saw a couple of cases in Europe, that's when we thought this in one scenario could become much, much worse. So that's an example of how we say, right, something's come onto the radar and let's track it as it goes along. Now, having identified those potential risks, you then need to think about what can we do about it? And we track a number of different ways of managing or reducing essentially equity risk. We can use futures to just sell equity delta and have less equity exposure, or we can use certain types of options where we'll buy puts in the market, and that gives us specified payoffs. So we know if we put in, for example, $1 or €1, out of that payoff we might get 4 or 5 back if that bad scenario occurs. And if it doesn't occur, well, we will lose that insurance premium, but we'd be okay with that because all the rest of our portfolio would have done fine. So that second stage, the first stage is identify risk. The second stage is look at the price of the insurance and decide if it's worth putting it on. That is worth doing. And obviously, the earlier you do it, the better. The third part of the process is to make sure that once you've gone into that scenario, even if it wasn't your base case, that you then monetize that hedge that you put on. Hence, you can add value to the fund when the markets start to move back up. So to come back to the example, we saw cases in China. Okay, we'll monitor it. No change to portfolio. We saw cases in Italy. We reduced equity exposure significantly, and we'd already been more in government bonds. Then, as it became really difficult over here, markets came down. So we said, right, we're going to monetize that hedge now. We bought back the equities. We took off any other hedges we had, and then markets went back up. And so it worked out well for the fund. I should say, though, there are times when we think, you know, we're worried about something, we put on a hedge and it doesn't happen. And that's then a slight reduction in performance. But we found that overall, this approach, this active approach, adds value to the fund and is better from a risk management point of view as well.
Thank you very much, Simon, for your explanation. And yes, it makes sense to stay more on the cautious side, maybe to be cautious one time too much, because that's usually what I've seen that many investors look for, that they have a good drawdown management. But of course, most of us underestimated the outcome of the COVID virus. So good that you had it figured in, maybe not in your base case scenario, but you had it as a scenario also. and position the fund accordingly. Before we move on to the ESG questions, I would like to sum up the key points for our participants in German and quickly, and then we could move on. So, bevor wir weitermachen mit den ESG-Fragen, wollte ich für Sie noch kurz die Kernpunkte des Ansatzes zusammenfassen. Also hier in dieser Multi-Asset-Strategie werden neu mit einbezogen alternative Anlagen, börsennotierte alternative Anlagen, wie beispielsweise Immobilien, börsengelistete Immobilien oder börsengelistete Infrastrukturgesellschaften, weil das die Diversifikation im Portfolio verbessert, wobei das Portfolio generell eher als balanced oder eher vorsichtig zu bezeichnen ist, weil die Aktienquote maximal 50% beträgt. Dazu kommen dann 15 bis 20% alternative Investments. Und der Nachhaltigkeitsansatz ist integriert, damit Anleger auch anhand ihrer Werte im Einklang mit ihren Werten investieren können. Ein großer Fokus des Managements ist das Risikomanagement. Das heißt, es wird versucht, Drawdowns oder Einbrüche an den Märkten zu antizipieren. Beispielsweise, wie man es gesehen hat, letztes Jahr mit dem Corona-Ausbruch in China, dass da frühzeitig einfach Hedges eingegangen wurden mittels Derivate durch Futures oder den Verkauf von Put-Optionen, das Portfolio abzusichern. Aber wichtig ist eben auch, dass man die Absicherung rechtzeitig wieder auflöst, um den Aufschwung nicht zu verpassen, der letztes Jahr doch recht plötzlich kam. Gut, dann würde ich sagen, machen wir weiter mit den ESG-Fragen und ich würde wieder ins Englische überwechseln. Simon, now I would like to ask you some question about ESG, because your approach at BMO is called Avoid, Invest and Improve. Could you please give us an overview how it works in practice?
Certainly, and I hope you can still see the slide, Barbara.
Yes, I can see it. Thanks.
Okay, so as you said, avoid, invest and improve. And before I go into each of those, I think what I should start by saying is sustainability as a way of investing has grown so much in the last few years. Even though, as I said at the very beginning, we've been doing some of that since 1984, but clearly the last 5 years it's become much broader and it's moved beyond equities to bonds and multi-asset and so on. Now, as that's happened, there are so many different words and terms being used with sustainability. So we think it can get quite confusing for everybody, including us at times. And so we created this framework to really help us to make sure we understand and we can easily communicate what is happening in the portfolio. And what you've got the first part, which is called avoid, and that is about excluding certain types of company, whether it's because they make a certain product. And in our case, we will exclude fossil fuel companies, we'll exclude tobacco manufacturers, and we'll exclude weapons manufacturers. And we don't want those. So different products we keep out. Or we will exclude companies which have poor conduct. So we will score different companies in terms of ESG risks. We will look at those companies that have been judged to have breached United Nations Global Compact guidelines. Generally, it's to do with bad governance, or for example, the scandal a few years ago with the diesel emissions testing at Volkswagen, and any company where we say they don't conduct themselves well, we will avoid that. And we have a similar approach with government bonds. So that's the first part, which is avoid. The middle part of this is called invest, and that's saying, well, okay, let's try and understand what are those opportunities in the world that help us as a planet, as a society, to be sustainable in the long term, while still being able to go about our lives, have a sort of capitalist economy, allocating capital to where it's useful and needed, and allowing people to have meaningful work. And that is the main focus of this fund. And we'll talk about that a bit more shortly. But what it gives us is we start with the United Nations Sustainable Development Goals, and they need so much money to be invested, that there are plenty of opportunities for investors to help make products or invest in companies that make products that solve those goals. We need $4 trillion a year, it's been estimated, to do that. We look at those goals and then we turn it into some investable themes. And that is really the main focus of the portfolio, building that up. The improved part is about working with those companies that we've invested in and engaging with them to help them to understand that even if they make a good product, perhaps they can improve some aspect of their business. Maybe it's the way that they treat workforce, maybe it's their supply chain, maybe it's about how efficiently they use resources. And we will have an ongoing dialogue with those companies, and we will aim to work with them to get them to improve their practice. And we can also, because we have this role as stewards of capital, we can vote with or against management. So if we're really uncomfortable with the company on a certain issue, we can vote against management at shareholder meetings, and that allows us to use the power we have on behalf of our clients who've invested in these funds. So between those three parts, avoid, let's not have the bad companies, the ones not well run. Invest, let's put the capital into great opportunities, both from an investment perspective and from a sustainable perspective. And finally, let's work with companies to help them improve best practice as time goes by.
So thank you very much for that summary of your investment process. Would it be possible that you run us through a company example, how you analyze ESG in a live company, and maybe how that fits into your framework?
Certainly. Well, I have an example which we have on the slide here. And so this example, it's a Dutch company called DSM. And it's mainly, the main focus of this company is nutrition technology, let's say, as a broad term. 80% of the revenues come from that. But they have one specific product which we're really excited about, which they've worked on for some time, called the clean cow enzyme. And the problem is, in agriculture, in farming cows, they give off a lot of emissions. It's not carbon dioxide, it's more methane. But that can still have a significant effect on the environment over the 10 years that it takes to break down. And farming in general, livestock farming, so cows and pigs and so on, they create roughly the same amount of emissions as cars globally. So it is a meaningful problem. And this product made by DSM is actually something that halves the methane emission of all of these cows. So if that could be deployed globally, that really would significantly help reduce our greenhouse gas emissions globally. And it's something which they've made that they put into the food the cows eat, and it doesn't have any side effects other than to reduce these emissions. So for us, this is a really exciting opportunity. It's a good company. But if we look through the framework that I just talked about, we'll think first of all about avoid. So firstly, is it related to tobacco, weapons, or fossil fuels? Clearly no. And even if this is the main part of their business, we'll check other parts of the business just to make sure that they don't have some other subsidiary somewhere which happens to do fossil fuels or something. In this case, they don't. So that's good. And from a conduct perspective, do they conduct themselves well? Are they well governed? Do they manage their ESG risks well? We think yes. So it's fine. We don't have to remove it from our opportunity set. To look at invest, well, I've spoken about that a bit already, but you can see up in the top left corner of this slide, it links to the United Nations Sustainable Development Goal of zero hunger. And it is part of facilitating a sustainable supply of food to the world. And clearly, as a product, it's a very exciting product, which we can see a huge opportunity for in the market. And then in terms of engage, we will now go and talk to this company, and we will start to talk to them about some other things. I think in this case, we've been engaging with them on executive remuneration and making sure that that looks appropriate when compared to other similar companies. So that's the avoid and the invest and the improve. But I would also like to add that aside from the sustainability part, we very much care that we can get good returns from this company. We will look at the cost of capital for this company, and we include some ESG factors within that to help us adjust it if it looks like it needs to be slightly adjusted. But we'll get a sense of their cost of capital. and we'll then get a good sense of the return on invested capital that we can expect to get. And as long as we can expect to get a better return than the cost, then that means it's a good prospect from an investment perspective, as well as a sustainable one.
Well, thank you for running us through that interesting example, Simon. And I think there's definitely a market for that product, because when cows are as bad climate killers than cars, then this is definitely a product where I see a lot of positive outlook for that. So we have also spoken about investment themes prior to my last question. So I'm wondering which investment themes you have identified for your approach, and how are they reflected in the portfolio?
Yes, so I spoke earlier about there being, on the invest part, so this middle part, we start with the United Nations Sustainable Development Goals, of which there are 17, and I will not list them all now, but we boil that down to 6 core investment themes, which we think are a good way of understanding sustainability and being investable for a portfolio. And I will just go back to the slides. And well, if we could go back to the slides, then I can show you a diagram where I have these 6 themes laid out. I'm just going to move that along. So here we have quite a busy slide, but what we have here is 6 themes, and each of them links to at least 2 of the United Nations Sustainable Development Goals. But it's a lot more tangible and easy to turn it into these themes. So some of these are, you would say, almost obviously sustainably linked. Health and well-being, that example I just gave of DSM being linked to food, but we have plenty of other companies in the portfolio that link to, for example, healthcare, which clearly is helpful from a sustainability perspective. Resource efficiency, so that's about reusing, recycling, and access to clean water, for example. One name there, Umicore, has become very, very good at taking complex waste, as they call it, which has many different industrial metals, and then extracting from that some of those metals in a purer form, and then allowing them to be used again. So that's a good reuse and resource efficiency name. And then energy transition, I'm sure everybody's heard of Ørsted already, because they are the world's largest provider of offshore wind. But when we look at energy transition, we know we need to move to renewable energy over time. Clearly that's challenging, but companies that help facilitate that, like Ørsted or like Vestas, who make the wind turbines, those are easy things to put into our portfolio as long as the investment case is right. Those 3, the top 3, most people would agree are sustainable. The bottom 3, I think, are more general, but actually we think this is where most of the opportunities lie. So if we're going to convert capitalism essentially to be fully sustainable, we need to provide capital to people in a sustainable way. We need to be able to innovate such that goods and services, parts of our economy, can do what they already do, but in a much more efficient way. And we need to make sure that the cities that we live in are themselves evolving to be sustainable in use of energy, transport, efficient use of information, and actually being effective places to live for all the people that live there. And by using these 6 themes, we've been able to allocate all of our capital into positive areas with good investment prospects and with good alignment with the portfolio.
My next question would be about how you measure the impact that the companies have generally. And so I think we can measure, we already have some measurements for the environmental part, like, for example, carbon intensity, carbon risk, but there are also the social and the governance component. So how do you measure these, and how do you report these measurements? Could you please give us an overview about your sustainable reporting and which indicators you look at, or maybe even which benchmarks you use for measuring your effectiveness?
Yes, well, I think Obviously, I've spoken a lot about what we say we do, and it's very useful to be able to evidence that we are doing it. It can be quite complicated. I've got 2 slides here that show you the large part of what we actually report on. Every year we create an impact report, which we send to investors, which tells them all of this information and actually some more. The first thing we do is we'll take all of those companies that we have in the portfolio, and we'll look for each company. What does that company do? Where does its revenue come from? And how can we align or map those companies' revenues to the United Nations Sustainable Development Goals? And what we're looking for is a portfolio that is mainly well aligned. It isn't going to be 100% aligned. Sometimes a company that we own may have a subsidiary that doesn't do something that we think is a good mapping, and we won't make things up just because it would be convenient. We'll just say there's no mapping. Equally, government bonds don't really have a clear mapping to sustainability. So that part of the portfolio we just show as neutral or government bonds. But most of the portfolio, from the equity side, the corporate debt side, and the alternative side, does map well. And this diagram, this sort of donut, if you like, shows the relative split of all of these different goals to our underlying holdings. And you can see that roughly 75%, just a bit more, of the portfolio does map well. And the areas that we have most weight are around health, which we just talked about, clean energy, as well as economic growth and technological innovation and economy. And that came back to those last 2 to 3 themes I mentioned, where if we're going to transform the world to make sure the economy can still operate and people can do what they want to do, then we need to change within that to make sure that those are efficiently run. So that's why those 2 areas, the numbers 8 and 9, end up being a significant part. We think there are many, many companies helping to make that better. So that gives you a sense of alignment to positive solutions. But as you mentioned also, we want to think about how well companies are using the resources that they use. So we have in this impact report, which is an example of is shown on the left, we have several different metrics. I've just taken 3 here. These 3 relate to environmental metrics, and they're trying to measure how much carbon or how much water or how much waste is being used by those companies in the portfolio. And we measure it in terms of tons of CO2, for example, to make $1 million of revenue. So it's used as a revenue metric. And what you can see is our companies, which are shown in the darker blue, are quite efficient in terms of using these. We've compared them against a benchmark. And in this case, it's a multi-asset fund. So it can be quite complicated to make a benchmark. What we've done is to create a composite based out of equities, corporate debt, government debt, alternatives, and to have the same asset weights in the benchmark as we have in the fund, to make sure that we're not looking good just because we happen to have something which may be a better intensity, but with a different asset allocation from the benchmark. So they are aligned when we compare that benchmark with the fund. And you can see in all of these 3 areas, the fund is much, much more efficient in using carbon, water, and waste. We should expect that because we've built a sustainable fund, but it's also good to evidence it. We also have similar data, which I haven't got on the slide, when we look at things such as gender balance and diversity, for example, to look at whether the companies we've invested in are employing people in areas with unemployment, which actually that really helps to stimulate the economy there, to take people into meaningful work. And we'll also look at the ratio between what the average pay is of a member in that company, a worker in that company, versus what is the executive pay for the top members. And we don't want to see a ratio that's too big, because we don't think that is good from a sort of cultural and governance perspective. But all of that data we generate once a year, and we put it into the impact report that you can see there. We also report on some other things, such as the engagements that we've done, and how many companies we've engaged with, and how well that has gone in terms of the the sort of oversight and governance of those companies meeting the milestones that we think are useful for them? Have they adopted new targets? Have they got new statements about anti-slavery? Are they becoming more efficient? And are they linking these goals to their executive pay? And taking all those different parts together, so the alignment from the page with the donut, the use of key resources and other metrics such as social metrics like diversity, and then engagement, voting, and milestones achieved. We package all of that into the annual report that we send out.
Thank you, Simon, for summing up the reporting. And I think reporting is also really important for sustainable investment strategies to see how effective these approaches are. And also because I think it's kind of a visualization that makes it more intuitive for investors to capture the effects of the sustainable investment strategy. Before we move on to our next pillar, I would say positioning and performance of the fund. I would just sum up quickly the key points of your ESG process for our German Participants. Also ich wollte kurz für die Zuhörer die wichtigsten Punkte der Nachhaltigkeitsstrategie bei BMO zusammenfassen. Der Nachhaltigkeitsprozess teilt sich in 3 Schritte auf: Avoid, Invest und Improve. Also zuerst gibt es Ausstoßkriterien, beispielsweise für Waffen, Tabakhersteller oder fossile Energieträger oder auch Unternehmen, die aufgrund bestimmter unternehmensspezifischer Eigenschaften ausgeschlossen werden. Als nächstes wird dann gezielt nach Unternehmen geschaut, die positiv zu den 17 nachhaltigen Entwicklungszielen SDGs beitragen. Und hier hat BMO auch 6 Kernthemen identifiziert, an denen sie sich orientiert bei der Auswahl von Unternehmen. Improve, also Verbesserung, ist der letzte Part. Und hier stehen die Fondsmanager und ESG-Spezialisten in Kontakt mit den Unternehmen und schauen sich Unternehmensbereiche an, wo sie sehen, dass Verbesserungspotenzial besteht und engagieren sich mit den Unternehmen, dass in den Bereichen noch etwas getan wird, beziehungsweise sind auch bei den Hauptversammlungen dabei und stimmen auch ab, beispielsweise über die Managementvergütung, und können auch negativ abstimmen, also quasi ihre Zustimmung verweigern auf den Hauptversammlungen. Ein wichtiger Punkt ist auch das Reporting. Man möchte ja auch sehen, kommt es wirklich an, der nachhaltige Prozess? Ist das Unternehmen wirklich nachhaltiger? Und da gibt es zum einen natürlich, dass man schaut, wie tragen die Unternehmen zu den 17 Sustainable Development Goals bei, zu den 17 nachhaltigen Investmentzielen, Entwicklungszielen, aber auch beispielsweise die Umweltfaktoren. Wie ist der Ressourcenverbrauch, beispielsweise von Ressourcen wie Wasser oder Abfall, oder natürlich vor allem auch Carbon, CO2, Intensität und Risiken. Das wird alles gemonitort, aber auch soziale Aspekte wie beispielsweise Diversität, Managementvergütung. Und da ist eben Reporting, das wird einmal im Jahr veröffentlicht, der Sustainability Report, sehr, sehr wichtig, dass man da auch sieht, wie der Prozess dann auch wirkt. So, dann würde ich wieder ins Englische wechseln und dann kommen wir zu unserem nächsten Teil, Positionierung und Performance des Fonds. Good. So, Simon, now I would like to come to positioning and performance of your fund. So your fund follows a relatively conservative strategy with a maximum of 50% equities. So fixed income make up a significant part of the portfolio. And this is really something that bothers me, that bothers our participants. How do you position in a market which is such challenging than fixed income?
Yes, well, it is certainly a difficult time from that perspective. Perhaps the easiest thing is if I go to the asset allocation slide that I have, which I hope is about to appear, and then talk you through what we've done, and then we can come back to what we're thinking at the moment. So you can see on this slide, the dark blue is the equity allocation, the lighter sort of blue is credit, and then the green, the sort of darker green, if you like, is government bonds, and then the lime green at the top is alternatives. And to go back to when we created this sustainable fund, we had a sort of reasonable equity allocation of about 30-odd%. We had a very low allocation to corporate debt because that looked expensive to us, and we had a reasonable allocation to government bonds. Now, as we got into the beginning of 2020, you can see that dip in the bottom part of the chart, which is when we decided to reduce equity exposure that we talked about earlier in the risk mitigation example. As markets sold off, we then added that back, and then we saw much better value in corporate debt relative to government debt. And so we've gradually allocated more of the fund, as you can see, over coming months, away from away from government bonds and into corporates. And the alternatives allocation, that was relatively static initially. We then reduced that last year, and that was because we had one strategy that wasn't working well, so we just got rid of that. But then we've been growing that over time as more sustainable alternatives have come online. Now that brings us to today, and this takes us, it would actually say June if the chart showed June. So at the end of June, we still have a relatively good allocation to equities. It's about 40% out of the maximum of 50. The alternatives have grown, and you can see that we have a very low allocation to government bonds, but we do have a decent allocation to corporate bonds. And when we were looking at fixed income, which is to your question, our worry, and even now, I mean, this week's been a bit different, but the first worry is if we're having fiscal and monetary stimulus all around the world in such a concentrated fashion, is that not going to be inflationary? Now, that's a difficult question to answer, but what we did expect was that markets would be concerned about that, and hence government bonds would sell off and yields would go up. So we had a very low allocation at the beginning of this year to government bonds. And corporate bonds are still affected, obviously, by yields, but they have an extra bit of spread, which gives you extra compensation for the risk that you've allocated. And as well as that, you can expect their price to go up to some extent as risk and companies themselves align better in the economy. So the spread between government bonds and corporate bonds narrows, and that helps performance. So even though bonds generally are a bit of a worry for us, we didn't want to have maximum equity risk, and we allocated most to corporate debt. After government bond yields went up significantly, government bonds were a bit cheaper, so we increased our allocation to government bonds marginally, as you can see in the March area. Since then, we've gradually moved that back again. Government bonds had rallied significantly, and hence we've come back to the situation we're in again today, most of our risk being in corporate bonds. In terms of the outlook, and I know it's a difficult question, we think that some of the inflation that we're seeing is transitory, i.e. it's there only for a short period of time. And we also think that central banks will not want to remove support for bond markets too quickly. So we think that to that extent, it offsets the longer term trajectory for yields, which we think are gradually rising. We are worried at times that you might get a sudden move in bond markets lower, but we think that that risk has mainly already been considered by market participants. So that's in the price, but it is something that we're thinking about for the next 6 months after we get through this slightly weaker period in markets. So we remain relatively positively positioned in equities. Our government bonds are low, our corporate bonds are significantly higher, and the alternative allocation we're gradually building as we find the right alternatives that are also sustainable.
Thank you for running us through your allocation over time. Regarding the alternatives part, I have a question for you. Can you give us examples where you see a sustainable alternatives, and maybe also what your target allocation for the fund is when the market is growing for sustainable alternatives?
Yes. So I think the question is well asked, because when you look at alternatives, that's the area that sustainability is perhaps least advanced within it. And normally alternatives might have property, it might have infrastructure, it might have private debt, private equity, hedge fund type strategies. There's so many different things. Now, what we want is we want that those opportunities are also sustainable. When you look right now within private equity, private debt, we can't find anything that's good enough that is pure and aligned against sustainability. We think there's a couple of things that we're tracking that will come over the next couple of years, but it's too early for that. But the area around property and around infrastructure, there are many opportunities. And we've seen, even in the last year, I think 5 or 6 new opportunities arrive. So there's 2 or 3 names which relate to renewable infrastructure. So that might relate to wind farms or solar panels, but also it can relate to sort of pipes and networks, if you like, that enable that renewable energy to be used and to be passed back to the grid. It might also relate to batteries, which allow storage of electricity, which is a useful part of the whole grid that you need if you're going to rely on renewable energy, because that isn't always available when you want it. So storing it is an important part. So out of the portfolio that we have, that allocation is to renewable infrastructure. But there's also the way the opportunity in property. And for us, there's 2 aspects to that really do align well. One of them is related to healthcare. So we have one name where the portfolio is made up of healthcare related property. So that could be, surgeries, doctors and medical areas. That's one thing we own. The other area relates to social housing, which is the provision of housing to people on low incomes who may not otherwise be able to afford to live in suitable housing. Or it might relate to the provision of housing to people who have special needs, maybe medical needs and so on. Now, the good thing about those areas is they do clearly align with a sustainable goal, but also in both cases, the income stream from the property is well protected and is stable. It can be supported with government subsidy. And if that is the case, the subsidies would be there for a long time. So for us, that's a good combination of a sustainable alignment and a good investment. And it allows access to those real assets such as property. In terms of the desired allocation, I would like to have the allocation at 20%, but I care that we have the right names in the portfolio. So we're only growing that over time as we find the right names. And typically we're looking at 2 to 3 names a month, new opportunities come to the market, and we assess them. We'll probably pick 1 in 3 of that deal flow. But if we can get to 20% whilst making sure it's well aligned and it's a good investment, then we would like to.
Thank you for your summary. So yes, and I think we can expect growing sustainable infrastructure over the next years, because we've seen that there's so much coming up, and also government programs routing money into building up sustainable infrastructure. So I'm pretty positive that you will have more and more opportunities over time to select for the fund. The next thing I would like to touch on is, of course, performance. So could you tell us a little bit about performance of the fund over the last years, and of course also how the inclusion of sustainability and alternative investment has influenced the risk-return profile of your fund?
Sure. Probably the easiest thing is to start with the performance page that I've got in here, which I hope everybody can see. So on this page, the darker blue line is the fund, and the lighter blue line is one of the peer groups that we use. We use both Morningstar and Lipper. This is the Lipper one. The Morningstar looks very similar. And what you can see is that in the first period, so since we converted this fund to be sustainable, really the fund has tracked the peer group. And that would mean it would just have been, say, middle of the pack. Partly, we knew that we were quite late in the cycle, so we didn't want to allocate capital to, as I said, corporate bonds that looked expensive. But then when we started to get the downturn that we saw at the beginning of last year, that more defensive approach that we took and again, reducing equity risk. That helped us relative to the average fund of this type of risk. So you can see we slightly outperformed on the way down by adding back the risk when markets looked a lot cheaper. And it really helped that we include valuation in our set of things to consider. We could put back the capital to equities. We can switch from government bonds to corporate bonds. So that meant that we were able to come well out of the market lows. And that led to outperformance over the whole of last year, really. Then this year, I would say we've more or less just tracked the market. It's hard to say on this page, but more or less as the market's gone up, we've gone up and so on. You might say the last month we've slightly outperformed, but we are happy to be keeping that the gap that we have over this whole period. You had a question about how have sustainable and alternatives helped. So on the sustainable side, that has helped significantly. One of the things you get with a sustainable portfolio is you can get more of a sort of growth bias within that. And if you think, essentially, we're buying companies who are innovative, and at a time when the market is not seeing growth elsewhere, there'll be a premium for those companies. So even if the market's going down, our sustainable holdings will have gone down less. When the market was bouncing, they bounced more. And that's certainly been very helpful from the perspective of last year. This year, that fact has been more mixed. At times, value type investments have outperformed. So at the first part of this year, that didn't help us. But we've allocated now some of our equity exposure to much more of a sort of yieldy aspect while still being sustainable. So we've now got probably a more appropriate mix of styles within equity that will help us in the next few years. That's one part of it. In terms of the alternatives, what they help to do is they give ongoing income, and they give opportunities to grow when equities have stopped moving as strongly as they did last year. So last year they helped a bit, but no more than they didn't help as much as equities, let's say, but they did generate some income. But this year they've been very helpful. New names coming in have typically gone well at launch, and so that has helped us this year. So they've been certainly additive this year. In terms of the general outlook, clearly there's a lot that relates to the economy and companies improving as lockdown comes out and earnings can grow. But I would also say there's so many tailwinds behind the sustainable fund, because we've got consumers, we've got investors, governments, regulators, and companies themselves all wanting to move in this direction. So that then means that the sorts of stocks that we own have a lot more money chasing them. And we think this will underpin performance in coming years.
And thank you very much, Simon, for your summary of performance. I think we are getting close to the end of the webinar. So I just would like to sum up your key points for the audience in German.
Sure.
So, dann wollte ich noch kurz die Kernpunkte zur Performance des Fonds und zum Portfolio zusammenfassen für Sie. Im Portfolio ist ja traditionell, dadurch, dass die Aktienquote auf 50% begrenzt ist, ein sehr hoher Rentenanteil. Und Renten, das wissen wir ja alle, hatten nicht das einfachste Marktumfeld in den letzten Jahren, haben wir ganz gut performt, aber der Outlook ist natürlich schlechter geworden, weil es gibt am Horizont Inflation, Zinsen sind niedrig, könnten aber vielleicht steigen, vor allem auch in den USA, wenn auch moderat. Es ist einfach kein gutes Umfeld, und da hat man auch im Fonds gesehen, dass Simon eben von Staatsanleihen in Richtung Unternehmensanleihen umgeschichtet hat, weil da einfach noch größere Renditeaufschläge zu erzielen sind. Und dann wurde die Alternativesquote im Zeitablauf ein bisschen hochgefahren. Allerdings ist sie noch nicht ganz bei dem Ziel von 20%, weil es einfach in vielen Bereichen auch noch Widersprüche gibt hinsichtlich Nachhaltigkeit dieser Investments, die sich beispielsweise im Infrastruktur- und Immobilienbereich bewegen. Und da suchen eben Simon und sein Team gezielt nach neuen Opportunitäten zu investieren. Dennoch hat sich die Strategie des Fonds sehr gut geschlagen. Man hat letztes Jahr gesehen, dass er weniger verloren hat, während die Märkte gefallen sind. Dieses Jahr ist er leicht vorne, 2021. Und letztes Jahr war vor allem auch die nachhaltige Ausrichtung gut für den Fonds, weil zum einen viele Themen profitiert haben im Zug der Corona-Krise und wir auch festgestellt haben, auch bei Scope, dass es so einen Gleichklang gibt zwischen Qualität und Nachhaltigkeit, was die Performance getrieben hat. Dieses Jahr waren vor allem die Infrastrukturinvestments, die alternativen Investments, die beigetragen haben, dadurch, dass sie eben stabile Erträge über den Zeitablauf generieren und eben auch jetzt, wo vielleicht Sustainable-Aktien oder Wachstumsaktien keinen Lauf haben, dass das eben so ein bisschen auch kompensiert hat auf der Seite. Da sieht man auch ganz schön, wie das mit der Diversifikation im Portfolio funktioniert. Alles in allem hat es bis jetzt sehr gut geklappt und es gibt auch starke Treiber, dass nachhaltige Investments auch zukünftig gut performen werden, sei es durch die Gesellschaft, sei es durch politische Anreize, sei es auch durch den Klimawandel, der uns alle beschäftigt und den wir auch jeden Tag, auch in Deutschland, am eigenen Körper spüren, dass wir das Thema angehen müssen. Und da gibt es sehr, sehr viele starke Treiber. Von daher sieht Simon sehr gute Aussichten, dass die Nachhaltigkeitsstrategie auch weiterhin einen Mehrwert für Anleger schaffen und ihnen auch die Möglichkeit eröffnet, im Einklang mit ihren eigenen Werten und Zielen zu investieren. So, I think we have come to the end of the webinar. So I want to thank you very much, Simon, for being here today, explaining your strategy, explaining how you invest sustainable. I think we learned a lot today about your approach and about also the environment or the outlook for sustainable investments, and also about including alternative investments into multi-asset portfolio and why it makes sense. So thanks for being here today. I wish you a great day, and also I wish our participants a great day. Thank you for being here. You can find a summary of the webinar on our website, www.scopeexplorer.com. And there you can also find fund information and information about the upcoming webinars. So thank you very much. Have a great day and goodbye.
Thank you.
Thank you.